Yeah, I mean, it's very easy to get seduced by the attractive interest rates from cash deposits at the moment. I think you can get maybe 5, 6% in a relatively straightforward bank account. And if you compare that to something like the FTSE All Shares yielding just under 4, equity income fund like ours yielding about 4.5%. So, I mean, on the face of it, it looks a bit like a no-brainer. However, what that kind of thinking doesn't include is anything to do with income growth. A traditional bank deposit is just going to pay you a flat amount every year. Stocks or equity income funds tend to grow their dividends over time. And in the medium to long term, it's the growth in income, not the starting yield, that is going to really make the difference. Just to give an example of that, if you just compare two investments, both yielding 5% on day one, let's say, the first one, a bank deposit, is just going to pay you that 5% every year. If we say that the other one grows its income at 4.5% a year, and I would pick that number just because that's what the Rathbone Income Fund has grown its dividend in the last 30 years. That's the average dividend growth rate. Then by year 10, the growing income stream will be paying you about 50% more income than a traditional bank deposit. By year 15, it's going to be paying you about double the income you would get from that flat income stream in a bank deposit. So as I said, over the medium to long term, it's the growth in income, not the starting yield, that really matters. So you have to consider that. It's not enough just to look at the starting yield if you're seeking income.